We are pleased today to welcome Jon Najarian to the Income Generation. You might be more familiar with Jon and Pete Najarian together, or with their ads on options trading, or perhaps you've read their 2013 book entitled How We Trade Options, Building Wealth, Creating Income, and Reducing Risk. Jon, or Dr. J. Najarian, was a linebacker for the Chicago Bears before he turned to another type of contact sport, trading on the Chicago Board of Options Exchange. He became a member of the CBOE, the New York Stock Exchange, the CME, and the CBOT, and worked as floor trader for some 25 years. Today, he's a professional investor, money manager, lecturer, as well as co-founder of Najarian Family Office and Rebellion Partners. Jon, welcome to the Income Generation.
Great to be with you, Dave. Thanks.
You know, options are generally considered to be something very complex by your average investor, but they don't have to be. How do you explain options to just your average middle American investor?
Right. Options, as you say, do seem mystifying, but shouldn't be really. The most common use of the same for us in everyday life is an insurance policy, where that's a put option. People like Warren Buffett love put options because they get to keep the premium for the policy they issue, and they're providing a valuable service. They're insuring the downside of some asset. You can do the same thing with a stock, and that put option insures the downside of Google or Apple. And like I say, Warren Buffett, Bill Gates, a whole bunch of real smart people, Michael Dell, they sell puts like crazy. Why? Because they're big risk takers? No, but because they think the premium taken in is worthwhile, and they're willing to buy that stock at a lower price, whereas maybe an individual investor with either a shorter time frame or less money isn't as willing to take the ups and downs in the market as much.
You know, it's interesting because you talked about hedging, and most investors, though, think of options as being risky. They think of it as speculation. You know, when you're speculating, what would you tell the average investor, somebody who's retired or within 10 years of retirement, is to how much of their money as a kind of a guideline maximum should they be using for speculation? We'll get to the hedging in a minute, but at this point, what percentage for speculation is a guideline for your average investor?
You know, that's a great question, Dave, because I think a lot of investors, the older they get, obviously the larger the nest egg generally is, but unfortunately, they probably are taking too much risk with that nest egg, something they wouldn't have been comfortable with, for instance, after their 30s and even 40s. Now all of a sudden in their 60s and 70s, they're taking too much risk. I don't think that should be probably more than 10% of somebody who's within 10 years of retirement. I don't think they should be taking shots or, you know, making that big investment, if you want to call it that, looking for a windfall. I think they need to more or less just grind out steady returns, and that, as your show implies, the income generation is what's going to make them richer in the long run, rather than taking a bunch of shots, most of which might blow up on them.
You know, using options from a speculative basis is usually something like people think about buying call options if they think a stock is going to go up. You know, can you give us a recent example of where you've had success speculating with maybe even for some member of the income generation with a small percentage of their money? Just to give an example of where using options on a speculative basis actually made you a significant gain?
Sure. You could take a look at U.S. Steel, for instance, symbol X. U.S. Steel, of course, is a steel stock. Biggest one in the world right now is Mittal, but U.S. Steel is still a pretty significant competitor. We bought some at-the-money calls in U.S. Steel. The stock made about a 4% move over the next week, but the options more than doubled. So in other words, you could make 4% on, for instance, a $20,000 investment. That comes out to about, what, $800? Or you could put that same $800 into options and turn it into $1,600. So those are examples that exist every day, whether it's Cisco, whether it's Microsoft or Google, where you can basically buy an at-the-money or just out-of-the-money call And it doesn't take a big move in the stock, Dave, to turn that into a big winner for you.
Absolutely. It's leverage, and leverage works great when things are going well, accentuates your gains, and of course can do the opposite if things work against you, as you well know. So we're talking today on the show about the market in general, and what's your take on this? The market seems to be at a high level today. It seems to be defying gravity. What's going on in your personal opinion?
Well, I think as stated by, the likes of the Fed Chairman Janet Yellen, or Abe over in Japan, or Carney in Great Britain, or Draghi in Europe, these are all people that run central banks for these countries. And they're trying to force us, you and me, into riskier assets. That's one of the purposes of lowering the interest rates, is to make it unattractive to leave your money in a bank. They would rather have us commit capital to financial markets, and thus, by getting us out of bonds and into fixed income investing, they can hopefully drive some demand by these big companies, by Apple, by Google, by Microsoft, and so forth. And to a certain extent, that has worked. But obviously, a lot of investors, as they get closer to retirement, are feeling a little unease with the market here at these record highs. But I think lower for longer on interest rates, Dave, means higher for longer out of the stock market as well.
So without all this external stimulus, you agree that the market is on the highish side. But with all this external stimulus, it could go higher before it takes its next significant drop. Is that what I'm hearing?
That is correct. And there could be an incident, though. There could be, none of us want to see a terrorist incident, but it certainly could be that. It could be banks in Europe that all of a sudden have more than just a hiccup that could cause us to make that correction, whether it's 10% or more. That could still happen even with very low interest rates. And that's more or less, I think, why our Fed is trying to get a little further away from zero. That's why they moved rates up 0.25% last December. And it's why we're likely to see another increase, a small one, very small one, this coming December. But between now and then, David, I don't think we see any rate increases.
And that's the biggest thing that our income generation members struggle with every day, is trying to figure out, gee, if the market is defying gravity, if it shouldn't normally be at this level, but it's there for reasons, external reasons that we understand, the thought is, how much money do I really want to gamble in common stocks or stock funds? So when we come back from the break, we're actually going to talk about that. We're going to talk about ways that Jon uses options to hedge in times like this, and also to increase income for members of our income generation. Stay with us. We'll be right back after the break. Welcome back. We're here today with options expert extraordinaire, Jon Najarian. Jon, we talked about using options for speculation, but I know as being a retired linebacker for you, it's more about defense than it is about offense in many ways. So can you talk about how an average investor can use options to protect the downside at a time like this when he may feel as though the market shouldn't be here, it's high, but yet understands why it's at this level and still increasing?
Sure. And Dave, I think a lot of investors probably are overweighted in stocks. And they are because of what you and I mentioned in the previous segment. The federal banks or the central banks have pushed them into riskier investments, taken them out of fixed income, which might be the equivalent of their age. In other words, 60% in fixed income, 40% in stocks. Doesn't really work when fixed income goes down to zero. So a lot of people are probably finding themselves with stocks that have more risk because of these elevated levels. So one of the things I would do is, in particular, if I'm in a tax-free or tax-deferred status, like an IRA or a Roth or something like that, is I would get in there and sell out some of these stocks and instead get into either in-the-money, longer-dated options, where I have a defined amount of risk, less risk than in that stock. Even great stocks like, again, Microsoft or IBM or Apple. I would rather be in the options, deep in the money options there, or in option spreads than I would like to be in those stocks. I think I can control my risk And I think, as you say, I'm a guy who likes to play defense. Offense is great, but in particular, as you get closer to retirement, you want to have that grinder mentality. You know, you'd rather hit like Ichiro and get, you know, base hits and doubles rather than swinging for the fences.
So sell the stocks, buy call options to protect your downside. So you still have the upside, but with less downside. And also put options, you know, buying puts to protect the downside. You know, stop losses in a volatile market like today, people put trailing stops in, as you know, and of course the market takes a big drop, you get stopped out, it runs up, and then you're sitting in cash. So do you use put options also to protect downside oftentimes?
I do. In fact, depending on the stock, whether it's FireEye, which is a volatile security stock, it's a cloud-based security stock, I would definitely have put options against my stock if I were in a volatile sector like that. But then you look at a lot of these retailers. They're having their lunch eaten by Amazon and others, soon to be Walmart now with their acquisition of Jet. And you have big downside moves. Kate Spade, for instance, handbag company. You wouldn't expect that stock to lose a third of its value in a single day, but it did just in the recent past. If you would have had a put option under the market, that put gives you the right to sell at that strike price. So just as you say, Dave, that gives you the protection so you don't have a 30% drawdown, because those can kill you or at least really inhibit your returns and keep you from living the lifestyle you'd like to live.
And most people don't realize that even if you buy a put to protect your downside, and let's say the strike price is 10% below the price of the stock, you don't have to crash through the strike price on the downside for it to work, because if it fills half that gap, the put's worth more, and people don't realize you can sell that put and actually make money on the put itself. But let's talk about income for a second.
That's
you know,
true.
because it's
Sure.
the income generation is the name of our show. A lot of people don't want to buy the put. They say, well, the put is, you know, I'm only getting a 2.5% dividend. I buy the put, that's going to eat up my dividend. You know, those people instead say they want to increase their dividend. So how about covered calls? Are those good for retirees who still want to hold some stock?
Absolutely. It's a great strategy. Income generation from basically, I look at it, Dave, as if you own an apartment. You're in South Florida a lot of the time. So South Florida, hotbed of real estate. How many people want to own an apartment in South Florida? And if they're not living in it, do they just leave it empty? They'd rather rent it out and collect that rent every month. With an option, you could sell an option every month. You could even do it every week, but most investors, especially close to retirement age, probably makes more sense to sell monthly or quarterly options. But again, you're getting a nice chunk of income, enhancing the yield of that stock, and it's just like letting that apartment out to a renter, except they can't wreck your stock. They could wreck your apartment, they could do all kinds of damage to the apartment, but they can't do anything to your stock. They just are participating in the upside of the stock from wherever that strike price is. I think that's a great way to play the market.
So let's say S&P 500 stocks today, let's say the average dividend is 2 or 2.5%. By writing covered calls, you can get your income from 2 to 2.5 up to what level would you say in today's market?
Well, especially on an annual basis, I think you could take it into the double digits, take it to about 11 or 12%, which is phenomenal when you're looking at 0 or 1/4%, even 0.5%. For, you know, the 2-year Treasury is right around, I think, 0.6%. So in other words, if I can get 10% for owning a stock like Apple, owning a stock like Cisco or whatever, and selling calls against that stock, I think you're in a great position to, like I say, live a better life in your retirement years because you enhance the yield rather than just sitting there with that empty apartment.
At the end of the day, to get 10% in the fixed income market, you'd have to go down to the C-rated range of junk bonds. And here you can own blue chip stocks and write covered calls and get similar income. So that's absolutely great advice for people who still want to have some of their money in common stock, even though they're retired or on the brink of retirement. So, Jon, we're out of time. All good things must come to an end. I appreciate our time together today. Thank you.
Thank you, David. Pleasure to be with you in the income generation.
And for our viewers, stay with us. We'll be right back after the break where Morgan and I go together on set to talk about today's financial markets and what you need to watch out for. We'll be right back.